Welcome, deep divers. Ever stare at a tax form and just, feel completely lost?
Happens to the best of us.
Especially with things like employee business expenses. It feels like this secret code, and your wallet's definitely paying attention.
Right.
Well, today, we're cracking that code. We're giving you the decoder ring for Form 2106.
Or at least trying to.
Our mission, to really unpack employee business expenses, zeroing in on IRS Form 2106, and the instructions for the 2024 tax year.
Yeah.
We're not just reading a form, though. We want to clear up the confusion, show you where potential tax savings might be, and flag those, really critical details if you're one of the people who still qualify.
And it's important to say this isn't just our opinions. We're pulling everything directly from the official IRS stuff.
Exactly. Form 2106, the instructions. The real deal.
Right, the authoritative source. So it's practical, current info for your planning.
All right, let's dive in.
The essential gatekeeper, who can even claim employee business expenses.
Okay, so first things first. There's this, huge assumption out there.
Well,
That if you're an employee and you spend your own money on work stuff, you can just deduct it.
right.
It feels logical.
It feels logical, absolutely. But with taxes, logic doesn't always line up with the rules.
Apparently not.
And that common idea, it's mostly wrong now. That's probably the single biggest takeaway for most people listening.
Wait, say that again. Most employees can't deduct these things anymore.
That's right. There was a massive shift in the tax law a few years back. The vast majority of employees simply cannot deduct unreimbursed job expenses anymore.
Wow, that's fundamental. How did so many people miss that? It feels like a door just slammed shut.
It basically did for most. Think of it, Section 67G of the tax code. It suspended most of what we used to call miscellaneous itemized deductions, the ones subject to that 2% AGI floor.
Right, I remember that.
Well, that suspension started after 2017, and crucially, it's still going through 2025. So for your 2024 taxes, if you're a regular W-2 employee, engineer, manager, admin, whatever, Form 2106 probably isn't for you.
So knowing that upfront saves a ton of hassle.
Exactly. Don't waste time chasing deductions that just aren't there for most people.
Okay, so it's definitely not for everyone. It's more like a VIP list. Who are these elite 4 people who can still file Form 2106?
Elite 4. I like that. Yeah, the IRS instructions are super specific, only 4 types of people.
Let's hear them.
Okay, first, Armed Forces Reservists. We're talking Army, Navy, Marines, Air Force, Coast Guard Reserve, National Guard, Public Health Service Reserve.
Got it. Reservists.
Second, Qualified Performing Artists, and they have some really specific tests to meet. We'll get into that.
Okay, artists but qualified ones.
Third, fee-basis state or local government officials, people paid by fee for government work.
Right.
And fourth, employees with impairment-related work expenses, so individuals with disabilities who have costs directly related to being able to work.
Okay, that's it. Just those 4.
Generally, yes. If you're not squarely in one of those buckets, Form 2106 is likely off the table.
That really narrows it down. And the instructions even have a slow chart to help figure this out, right? Can you walk us through that? Because getting that right is step 1.
Yeah, the flowchart is great, saves you reading pages if you don't need to. It starts with question A. Are you one of those elite 4, reservist, performing artist, fee-basis official, or employee with impairment expenses?
And if the answer is no,
Stop right there. Don't file Form 2106. Save your time.
simple enough. What if it's yes?
Then question B. Did you actually have job-related business expenses? If not, again, stop. If yes.
Going.
Question C. Were you reimbursed? And this is key. Only count reimbursements your employer didn't already include in Box 1 of your W-2.
The Box 1 distinction. Important.
Very. If you did get those non-Box 1 reimbursements, then question D. Are your deductible expenses more than those reimbursements? If not, you usually don't file because there's nothing left to deduct.
Makes sense. Expenses have to outweigh the untaxed reimbursements.
Exactly. Then it gets into vehicle stuff. Question E. Did you use a vehicle for work this year that you also used for business before?
Right.
If yes, then question FG is a bit technical. Did you own it and use the actual expense method the first year? Or did you use a depreciation method other than straight line in a prior year? If the answer to either of those is yes, you generally do need to file Form 2106, even if your expenses don't exceed reimbursements this year. It's about tracking that vehicle's history correctly.
Wow, okay, so that flowchart really filters people out quickly.
It does. A no early on usually means you're done with this form.
Now, there's one other specific group mentioned, rural mail carriers. They're told not to use Form 2106 sometimes.
Right. That's a special rule. If you're a USPS rural mail carrier and get that qualified equipment maintenance allowance, the EMA, under your union agreement, it's treated as an accountable plan reimbursement,
Meaning?
meaning your employer shouldn't include it in box 1 of your W-2. It's not supposed to be counted as taxable income.
So if it's not income, you don't need to deduct the expense against it.
Precisely. It simplifies things for them. The allowance covers the expense and neither hits the main part of the tax return. So no Form 2106 needed for that specific situation.
Diving into Form 2106 step by step for eligible expenses, Part 1.
Okay, so for our Elite Four listeners still with us, let's get into the form itself. Part 1, employee business expenses and reimbursements. It's got 3 steps and a little shortcut. If you didn't get any reimbursements, you can skip step 2. Just do steps 1 and 3.
Right.
Let's start with step 1. Enter your expenses. 2 columns here. Column A for most things, column B just for meals.
That separation is really important because meals have different deduction limits.
Yeah.
Mainly that 50% cut we'll talk about. Keeping them separate from the start is key for accuracy.
Makes sense. So line 1, vehicle expense. Where does this number come from?
Good question. You don't calculate it here. It actually flows from Part 2 of the form, which we'll get to later. There'll be either line 22 if you use the standard mileage rate, or line 29 if you use actual expenses.
Okay, so we circle back to that. And again, the note for rural mail carriers, if you got that qualified reimbursement, you're likely not even using this form.
Correct. That EMA allowance keeps them off this line.
All right, line 2, parking fees, tolls, and transportation, like trains, buses, stuff like that. But not overnight travel or commuting.
Exactly. And that no commuting part trips a lot of people up. It's a huge point. Your regular drive from home to your main office, not deductible, period.
But are there exceptions? Like, what if you work from home sometimes or go to a temporary site?
Yes. Good questions. Exceptions are key. If you have a regular work location away from home, but you travel to a temporary work location for the same job, that travel isn't commuting, it's potentially deductible.
How temporary is temporary?
Generally expected to last 1 year or less. If the assignment is longer, it might become your new tax home.
Okay. What about a home office?
If your home office qualifies as your principal place of business, under the IRS rules, which has its own set of tests, then travel from that home office to another work location for the same business is deductible, not commuting.
Okay. So understanding those definitions, commuting, temporary, principal, place of business, is crucial.
Absolutely critical for knowing what actually belongs on line 2.
Moving on, line 3, travel away from home overnight, lodging, airfare, rental cars. But specifically not meals, right?
Correct. Meals go on line 5. Line 3 is for the other costs when you're away from your tax home overnight on business.
Tax home, what exactly is that? Is it just where I live?
Not necessarily. It's usually your main place of business or post of duty. Your professional center of gravity, you could say, even if you live elsewhere.
So if I live in New Jersey, but my main office that I report to is in New York City, and my tax home is...
Likely New York City. Business travel from NYC would be away from home.
Okay. What if you don't really have a main place? Like a long-haul trucker?
The itinerant rule. If you have no regular place of business and no regular place you live, the IRS says you're basically never away from home. So sadly, no travel expense deductions in that case.
Ouch. And there's a time limit too, right? The 1-year rule?
Yes, that's important. If a temporary assignment is expected to last, or actually lasts more than 1 year, it's generally considered indefinite. Travel costs related to that assignment usually become non-deductible because that location effectively becomes your new tax home.
Got it. What about small things on trips, like tips for bellhops?
Those are incidental expenses. You can track them individually, or you can use an optional simplified method. $5 a day.
$5 a day.
Yep. But only if you aren't claiming any actual meal costs or using the standard meal allowance for that day. It's just for those minor tips and fees. It can be easier than tracking tiny amounts.
Okay, useful little shortcut. Now, line 4, other business expenses. Still no meals here. This sounds like a catch-all. Business gifts, education.
It is a bit of a catch-all, yeah. Business gifts have limits, usually $25 per person per year. Education expenses can fit here if they maintain or improve skills for your current job tuition. Fees, books, subscriptions to trade journals too.
Anything specifically excluded besides meals?
Yes. The instructions say no taxes, no interest on this line. Those might be deductible elsewhere, like Schedule A, but not here. Also, K-12 educator expenses, deducted elsewhere on Schedule 1. And definitely look into education credits first, like on Form 8863. A credit is usually better than a deduction.
Good point. Credits reduce tax dollar for dollar.
Exactly.
Yeah.
But here's a huge one, post-2017. No deduction for entertainment, amusement, or recreation expenses.
So taking a client to a ball game or golf.
Nope, not deductible anymore. Also, dues for most clubs, golf clubs, social clubs if they're for entertainment purposes, gone. You really have to separate business meals from entertainment now.
That's a massive change people need to know. Okay, finally, line 5, meals expenses. Here's where the food costs go. Travel meals, other business meals.
Right. And this is where the standard meal allowance comes in handy. It's often called the per diem for meals.
How does that work? Saves receipts.
It does. Instead of tracking every single meal cost while traveling away from home overnight, you can use a standard daily rate set by the government. It varies by location.
Where do you find these rates?
GSA.gov per diem for most of the U.S., the Department of Defense site for Alaska, Hawaii, U.S. territories, and the State Department site for foreign travel.
So you just use the rate for where you traveled?
Pretty much.
Yeah.
You still need to prove the time, place, and business purpose of the trip itself. You can't just claim the allowance without proof you actually traveled for business. But it avoids saving every little food receipt.
Definitely sounds simpler for the meal part. Okay, once all those lines 1 through 5 are filled in, line 6 is just adding them up, right? Column A totals and column B totals.
Simple addition, yep. That gives you your total expenses before considering reimbursements.
Which brings us to step 2. Enter reimbursements received from your employer. That's line 7.
Okay, this is critical. Line 7 is for reimbursements you got for the expenses listed in Step 1. Specifically, look at Box 12 of your W-2. If there's an amount with code L, that often goes here.
But not amounts already included in Box 1, your main wages.
Absolutely crucial distinction. If the reimbursement was already included in your taxable wages in Box 1, you don't put it on line 7. Why? Because you're already being taxed on it. Putting it here would mess up the math.
So ideally, how should reimbursements work?
Ideally, your employer uses an accountable plan. That means you adequately substantiate your expenses to them, receipts, logs, etc., and return any excess money. If they do that, the reimbursements shouldn't be in Box 1 of your W-2. They're tax-free to you.
What if my employer messed up and put it in Box 1 anyway?
The IRS advice is clear. Ask your employer for a corrected Form W-2, Form W-2C. Getting that correction removes it from your taxable income, which is the cleanest way to fix it, saves you hassle.
Good practical tip. Now, what if you get one lump sum reimbursement for, say, meals and lodging? How do you split that between column A and column B on line 7?
Allocation. There's a worksheet in the instructions just for this. It helps you figure out the meal portion versus the other expense portion.
Can you walk through that quickly?
Sure. Line 1 of the worksheet is your total non-Box 1 reimbursement. Line 2 is the total expenses covered by that reimbursement if the total's from line 6. Line 3 is just the meal part of those expenses from line 6, column B.
Okay.
Line 4 is a ratio. Divide meals, line 3, by total expenses, line 2, get a decimal. Line 5 multiplies your total reimbursement, line 1, by that ratio. That result is the meal portion of your reimbursement, and it goes on Form 2106, line 7, column B.
And the rest?
Line 6 is just subtraction.
Right.
Total reimbursement, line 1, minus the meal portion, line 5. That leftover amount is the other expense portion, and it goes on Form 2106, line 7, column A.
Okay, methodical. That ensures the reimbursement matches the expense type.
Exactly. Prevents misallocating and helps calculate the final deduction correctly.
Which leads us to step 3. Figure expenses to deduct. First is line 8. Subtract reimbursements, line 7, from total expenses, line 6.
Right. This shows your unreimbursed expenses. If it's 0 or less, you enter 0. What? Careful. If your column A reimbursement was more than your column A expenses, that excess might actually be taxable income you report elsewhere on Form 1040.
Good heads up. Now, line 9. Apply the 50% limit for meals. This feels important.
It's huge. Generally, you can only deduct 50% of your otherwise allowable business meal expenses. This applies after you've subtracted any reimbursements for those meals. So take the amount on line 8, column B, unreimbursed meals, and multiply by 0.50. That result goes on line 9.
So even if the meal was 100% legitimate business, you only get half the deduction.
For most situations, yes. There are very limited exceptions, like certain DOT workers. But for most people using this form, it's 50%. It's a hard limit applied right here.
Okay, 50% cut on meals. Then line 10, total deductible expenses. Add the unreimbursed non-meal expenses, line 8, column A, to the limited meal expenses, line 9. This is the final number.
That's the final deductible amount from Part 1. Now, the big question is, where does this number go on the main tax return? And that depends entirely on which of the Elite Four you are.
Right. Let's break that down. Where do Armed Forces reservists take this deduction?
Okay, for reservists traveling more than 100 miles from home For service, their deduction, limited to federal rates for lodging, meals, and standard mileage for car, plus tolls parking, goes on Schedule 1, Form 1040, Line 12.
Schedule 1, line 12. Why is that significant?
It's an above-the-line deduction. That means it reduces your adjusted gross income, AGI, directly. You get the benefit even if you don't itemize deductions on Schedule A. It's generally more advantageous.
Ah, okay. What about fee-basis state or local government officials?
Same place. Their expenses related to that fee-basis job also go on Schedule 1, Form 1040, Line 12. Another above-the-line deduction.
Okay, 2 for Schedule 1. Now, qualified performing artist, they had those strict tests. If they pass, where do their expenses go?
If they meet all 4 tests, the 2 employers, the $200 plus wages from each, expenses over 10% of arts income, and AGI under 1610K before these deductions, then their expenses also go on Schedule 1, Form 1040, Line 12.
So 3 groups get that above-the-line benefit on Schedule 1. What about the last group, disabled employee with impairment-related work expenses?
Their situation is different. Those expenses, attendant care at work, other costs needed to enable them to work, are deducted on Schedule A, Form 1040, Line 16.
Schedule A, so that's an itemized deduction.
Correct. It means these expenses only provide a tax benefit if they're total itemized deductions. Medical, state, local taxes up to the limit, mortgage interest, charity, and these impairment expenses exceed their standard deduction amount. It's not an above-the-line deduction.
Okay, that's a really important distinction in where the final deduction actually lands.
Deep dive into vehicle expenses, Part 2, where the real decisions happen.
All right, let's buckle up for Part 2. Vehicle expenses. This is where things can get pretty detailed for eligible folks. The big choice here is standard mileage rate versus actual expenses, right?
That's the core decision, yes. And the IRS flat out says you should figure it both ways each year to see which one gives you the bigger deduction.
So don't just assume one is better. Do the math.
Absolutely. It can change based on gas prices, repairs, how much you drove. Doing the comparison is smart tax planning.
Let's start with Section A, general information. This applies no matter which method you use.
Correct. Got to lay the groundwork. Line 11. Date placed in service. This isn't always when you bought the car. If you used it personally first, then started using it for business, it's that business start date. Crucial for depreciation.
Okay. Line 12. Total miles driven all year, business and personal.
Yep. And if you converted it mid-year, just the miles driven after the conversion if you don't have records for the earlier part.
Line 13. Business miles. And here it is again. Don't include commuting miles.
Can't stress that enough. Commuting is personal. Line 14 calculates your business use percentage. Business miles divided by total miles. There are special rules if you converted the vehicle mid-year.
Line 15. Average daily commute distance. Line 16. Total commuting miles for the year. Line 17. Other personal miles, they want it all accounted for.
You do. And then lines 18 through 21 are the big record-keeping questions. Was it available for personal use? Do you have another car? Do you have evidence? And critically, is the evidence written?
That written evidence part seems key.
It's everything. Section 274 requires adequate records, a logbook, diary, something contemporaneous. You need the date, miles, destination, business purpose for each trip. Without written proof, the IRS can, and often does, disallow the deduction, even if you genuinely incurred the expense. Good records are your shield.
Okay, message received. Keep. Good. Records. Now let's look at the methods. Section B, standard mileage rate. This is the simpler one.
Generally, yes. For 2024, the rate is 67 cents per business mile. You just multiply your business miles from line 13 by 7,067 cents. That's your deduction on line 22, which flows back to part 1, line 1.
Sounds easy. Any catches? Who can use it?
There are rules. If you own the car, you generally must have used the standard rate the first year you used it for business. If you did, you can switch to actual expenses later, but then you're stuck with straight-line depreciation.
What if you lease?
If you lease, you have to use the standard rate for the entire lease period if you choose it initially. No switching back and forth on a leased car once you've used the standard rate.
Okay. And is there anything else you can deduct with the standard rate?
Yes. This is often missed. You can also deduct the business portion of state and local personal property taxes you paid on the vehicle. That's not included in the 67 cents. It's a separate itemized deduction on Schedule A, line 5C.
Oh, interesting. So an extra potential deduction there. Okay, now for Section C, actual expenses. This requires more tracking.
Definitely. More receipts, more math. But potentially a bigger deduction if your costs are high. Line 23 is for operating costs. Gas, oil, repairs, insurance, tires, registration fees.
What's not included here?
Again, state and local personal property taxes, those go on Schedule A. And a big one for employees. Car loan interest is not deductible for employees using Form 2106. Self-employed people might deduct it, but not employees here.
Okay, no car loan interest for employees. What about leases on line 24 ABC?
Line 24A is your total lease payments for the business use portion. But 24B involves the lease inclusion amount. If you lease a fancier car, say, one worth over $62,000 when the lease started in 2024, you have to reduce your lease deduction by this inclusion amount.
Why?
It's to prevent people from getting around luxury car depreciation limits by leasing instead of buying. It basically adds back a bit of the lease cost to approximate the depreciation limit. You find the amount in IRS tables. Line 24C is your net lease deduction after subtracting that inclusion.
Okay, a complexity for higher value leases. Line 25, employer-provided car value.
That's specific. Only if your employer gave you a car and included 100% of its lease value in your Box 1 income, then you might list that here.
All right. And line 28 is depreciation. This seems like the main event for actual expenses. Leads to Section D.
Exactly. Section D is where you calculate the depreciation deduction, which is often the biggest component of the actual expense method.
Okay, Section D, depreciation of vehicles. This sounds like where the serious calculations happen.
It is. Depreciation lets you recover the cost of the vehicle over time. And there are ways to speed this up. The special depreciation allowance, often called bonus depreciation, and the Section 179 deduction.
Let's start with the basics. Line 30, cost or other basis. What goes here?
Usually it's what you paid for the car, including things like sales tax. But if you converted it from personal use, your basis for depreciation is the lower of what you originally paid, adjusted basis, or its fair market value on the date you started using it for business. Getting this starting number right is critical.
Okay, lower of cost or market value if converted. Then line 31, Section 179, deduction and special allowance. This is the acceleration part.
Correct. Section 179 lets you potentially deduct a large chunk or even all of the vehicle's cost in the first year instead of spreading it out.
Who qualifies for that?
You generally need to use the vehicle more than 50% for business in the first year. There's an overall limit on how much Section 179 you can take across all assets, $1,220,000 for 2024, phasing out if you buy too much property. And for SUVs, under 14,000 pounds, specific definitions apply. There's a separate limit of $30,500 for the Section 179 deduction itself.
Any other limits?
Yes, your total Section 179 deduction can't exceed your business income from your job and any other active businesses. The instructions give an example. If the car's basis for Section 179 is $25,000, but the overall first-year depreciation limit is $20,400, you use the $20,400. If business use is 75%, your Section 179 is $20,400, 75%, $15,300.
Okay, that example helps. What about the special depreciation allowance? Is that on top of Section 179?
It works together with Section 179 and regular depreciation, but there's an overall cap. For 2024, the total first-year deduction, Section 179 plus special allowance plus regular depreciation for a car, is generally limited to $20,400, multiplied by your business use percentage.
So you can't just stack them infinitely.
Right. The special allowance or bonus depreciation applies only in the first year the vehicle is placed in service. The instructions have a worksheet to calculate it, basically figuring out how much room is left under that $20,400 cap after you take any Section 179.
Can you choose not to take bonus depreciation?
Yes, you can elect out. You might do that if you expect higher income in future years and want to save the deductions for that.
Yeah.
But if you elect out, it usually applies to all similar assets placed in service that year.
Okay, lots of strategy there. After figuring line 31, line 32, basis for depreciation calculation, how does this work?
This is your starting point for calculating the rest of the depreciation over the following years. You take your original basis, line 30, multiply by business use percentage, and then subtract any Section 179 and special allowance you claimed on line 31. This reduced amount is what you'll depreciate using a standard method.
Which brings us to line 33, depreciation method and percentage. What are the choices?
First, if you switched from standard mileage to actual expenses, you must use the straight line method. No choice there.
Okay. If you started with actual expenses.
If your business use is over 50%, you can usually choose between 1, 200% declining balance, gives bigger deductions up front. 2, 150% declining balance, also accelerated but less than 200%. 3, straight line, spreads the deduction evenly over the car's life, usually 5 years. 3, straight line. If business use is 50% or less, you must use straight line.
Why choose accelerated if straight line is simpler?
Bigger deductions sooner generally means lower taxes sooner. But there's a catch.
Uh-oh. What's the catch?
The instructions have a big caution. If you use an accelerated method, because business use was over 50% initially. And then a later year, your business use drops to 50% or less. You might have to recapture some of those earlier excess deductions.
Recapture, meaning pay tax on them.
Essentially, yes. You add back some of the prior depreciation and Section 179 special allowance to your income in the year the use drops. It's reported on Form 4797. So be careful if your business use might fluctuate.
That's a really important warning. Okay, line 34 calculates the depreciation using the basis from line 32 and the method percentage from line 33. Any special rules if you sell the car mid-year?
Yes, you prorate the depreciation. For cars placed in service after 2018, it's based on the month you sell it. Sell JanSep, you generally get 50% of the annual depreciation. Sell OCDEC, it's prorated differently. You only deduct for the part of the year you used it.
Makes sense. And finally, line 36, depreciation limitations. More limits.
Yes, these are the Section 280F annual luxury auto limits. Even if your calculated depreciation is high, the IRS caps how much you can actually deduct each year for most passenger vehicles.
What are the 2024 limits?
For a passenger auto placed in service in 2024, if you do take the special bonus allowance, the first year limit is $20,400. Second year is $19,800. Third is $11,900. Fourth and later is $7,160.
And if you don't take bonus?
The first year limit is lower, $12,400. The limits for years 2, 3, and later are the same, $19,800, $11,900, $7,160. Remember, you always multiply these limits by your business use percentage, too.
So these caps can really restrict your deduction, even on expensive cars.
They absolutely can. However, certain vehicles are exempt from these limits. Things like ambulances, hearses, taxis, and crucially, trucks or vans over 6,000 pounds gross vehicle weight that meet specific design criteria, like having a large cargo area.
Ah, so if you have a heavy-duty work truck, you might avoid these limits.
Exactly. That can be a significant tax advantage, allowing much faster write-offs for those specific types of vehicles. Definitely something to look into if it applies to you.
Essential takeaways for smart tax filing.
Wow. Okay. We've really gotten into the weeds on Form 2106 and vehicle expenses. That was a lot. Let's try to boil it down. What are the absolute must-know takeaways for listeners navigating this?
Number one, without a doubt, record keeping. I know we keep saying it, but it's the foundation. Written logs for mileage, dates, purpose. Receipts for lodging always, and for other expenses over $75. Without proof, the deduction doesn't exist in the eyes of the IRS. It's the single best way to protect yourself and your deductions.
Records, records, records. Got it. What else?
Second, know your eligibility. Seriously, before you even think about the details, confirm if you're one of the Elite Four. Reservist, qualified performing artist, fee basis official, employee with impairment expenses. If not, this whole form is likely irrelevant because of that 2018-2025 suspension. Don't waste energy here if you don't qualify.
Right. Huge time saver to know that up front. For those who do qualify and have vehicle costs.
Third, choose the right method. Don't guess. Run the numbers for both standard mileage and actual expenses every year. See which one gives you the better result for 2024. It's worth the few extra minutes of calculation.
Compare, 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 and if actual expenses looks better.
Fourth, leverage depreciation carefully. Understand Section 179 and the special allowance for potential big first-year deductions if you qualify, but also be acutely aware of the annual limits and that nasty recapture rule if your business use drops later. It's powerful, but use it wisely.
Great summary. And if people want even more detail,
check the IRS publications mentioned in the form instructions. Pub 463 for travel, gift, car. Pub 529 miscellaneous deductions. Pub 587 business use of home. Pub 946 how to depreciate property. They have way more detail than we could cover. Outro.
Well, we journeyed deep into Form 2106 today. From figuring out who even gets invited to the party to the nitty-gritty of depreciation. Hopefully you feel a bit more empowered, less confused, especially if you're one of the folks who can still use these deductions for 2024.
Absolutely. And maybe a final thought to leave you with. Tax law is always shifting, always complex. So thinking beyond just this form, what's one area in your own finances, maybe something you've been avoiding because it seemed too complicated that you could commit to understanding a little better this year?
Ooh, that's a good challenge. Keep learning, keep exploring. That's what being a deep diver is all about. Thanks for joining us today. We hope this helps you navigate tax season with a bit more confidence.
Take care, everyone.
Catch you on the next deep dive.